So in the last class, we discussed the leasing decision. That is, whether the firm should buy or lease. First, we used the unfair comparison. So what we have done is we essentially calculated the firm's free cash flow from buying and the firm's free cash flow from leasing. And then we calculate the discounted value of these free cash flows. However, that was an unfair comparison because when the firm is leasing, the firm is taking on leverage. And when the firm is buying, the firm is not using leverage. So to do a fair comparison, we want to make sure that the firm is using the same level of leverage, whether it's buying or it is leasing. And to do this, we would consider the so-called lease equivalent loan, right? So basically, this is a loan which is used by the firm that leaves the firm with the same kind of leverage as a lessee. How do we compute this lease equivalent loan? Well, we will look at the incremental cash flows from leasing versus buying. That is, we will use the cash flows from leasing minus the cash flows from buying. So in this SpotFacts example, we will have these seven cash flows. And given this stream of cash flows, we can use several methods to answer whether the firm should buy or lease. And in the last class, we talked about the first method. So basically what you would do is you would discount these 6 cash flows using the after-tax cost of debt. And you will find out that discounted value is 39622, which is larger than 3800, right? So it's larger than 3800. This basically means lease is undesirable, right? Because it's like, well, if you lease, you would assume these liabilities and you only get $38,000. But if you buy with this loan, you will be able to get this amount of cash inflow on date 0, right? So basically, it means buying computers with the same amount of leverage is better compared with leasing computers. Okay, so today we will continue this example, and so let's first look at these 2 tables, and we can get a detailed look how the lease equivalent loan works. So first, the table on the top, well, we have discussed this table, right? Essentially here we are calculating the incremental free cash flows of leasing versus buying. That is, you're looking at the difference between these 2 streams of cash flows. And our focus is here, the table on the bottom. So here we wanted to understand how the lease equivalent loan will exactly work. So let's start with the lease equivalent loan. So here we are discussing the case that the firm is buying computers by taking out a loan, and this loan's amount is equivalent or is the same as the lease equivalent loan. So basically you can see that we will be able to find out the firm's loan balance, right? So how do you get these numbers? Well, it's pretty simple. So first, this number is obvious, right? Because we said if you discount these 6 cash flows, right, you will be able to get this 39622, and this is the day 0's amount. And then, how do you get this amount? Well, to get this amount, you would just discount these cash flows, right? Again, at the after-tax cost of debt. So similarly, for this, you will discount these cash flows, right? So this is how you get the loan balance at each date. And after getting loan balances, we can find out net borrowing, right? Net borrowing is easy. Net borrowing is essentially the difference between the firm's loan balances. Right? So on day 0, net borrowing is equivalent to the firm's loan balance. And then on day 1, net borrowing equals 29965 minus date 0's loan balance. Right? So this gives us the net borrowing on date 1. Of course, you can get other numbers similarly, right? For this guy, it's essentially 17599 minus 29945, right? And we can also compute interest because we know that the debt cost of capital is 8% and we have these loan balances. So use loan balance times the interest rate, we will have the interest payment. For example, for this 3,170, you will basically use date 0's loan balance times 8%. Right? So this is pretty simple. Obviously, you can do the same for other dates. Right? And then interest tax shield. Well, we know this from corporate finance too. Interest tax shield is always calculated as interest payment times corporate tax rate. And you know that the corporate tax rate is 35%. So it's very easy for you to calculate interest tax shield, right? For example, for this guy, for $1,109, it's just 35% times the interest payment, which is 3,170. And now we can find out the firm's cash flow from its debt, right? So here we can get these cash flows. These cash flows are firm's incremental cash flow by using the lease equivalent loan. And then we also know the firm's cash flow from buying computers, right? So if we add up these two streams of cash flows, that is this stream of cash flows and this streams of cash flows. So if we add these two streams of cash flows, then we will be able to calculate the firm's cash flows of buying computers with the lease equivalent loan, right? So, So again, our goal here is we want to find out the firm's free cash flow if the firm buys computers with these equivalent loan. To do this, we will add up two streams of cash flows. The first stream is the firm's incremental cash flow purely because of using debt. And the second streams of cash flow are the cash flows from firms buying computers without debt. Now, the interesting thing is, if you compare these cash flows with the firm's cash flows from leasing, you can see that cash flows on day 1, day 2 to day 6 right? These cash flows are exactly the same. And the only difference is the cash flow at day zero. And what you can see here is for leasing, the firm's day zero's cash flow is minus $12,000. But if the firm buys with lease equivalent loan, the firm's day zero's cash flow is minus $10,378. So what you can see here is, again, this difference. And you can see that exactly if the firm buys with the lease equivalent loan, it can save this amount. I guess it's 1622. It's 1622, right? So this number is exactly as the number we got here. Okay, that was some detailed look how the lease equivalent loan works. To be more specific, how the lease equivalent loan will change the firm's cash flows. So what you can see here is, okay, this is basically some summary here. The leverage is the same for the two approaches, right? Because you can see that these cash flows are the same. So leverages are the same for the two approaches. But the initial cash flow is not, right? Because you can see that we have a more negative cash flow in the case of leasing computers, and we have a less negative cash flow in the case of buying computers with debt. Okay, great. So using lease equivalent loan is definitely the correct approach, but it's actually complicated, right? Because you can see that at least it's conceptually more complicated, because you have to think about a fictional case. That is, the firm is buying computers with this lease equivalent loan. And here we can use a more direct method. What we will do is we will just basically calculate the net present value of the incremental cash flows from leasing versus buying. That is, we will look at these cash flows and we will calculate its NPV. And if its NPV is negative, then we would say that leasing is undesirable relative to buying, right? This is quite intuitive because you can see that these cash flows are the incremental free cash flows from leasing versus buying. So if the negative present value of these cash flows is negative, then this basically tells us leasing relative to buying is undesirable. So now we have a very simple approach. I mean, it's simple because in Corporate Finance 1, we have learned a lot about calculating net present value, right? So I would say that this direct method is the most intuitive approach. Again, now we will discount these cash flows with the after-tax cost of debt, right? And in this case, you can see that the number would be a negative $1,622. So judging by the NPV, we would know that leasing is undesirable. Okay. Now, the third method, we can also look at IRR. Remember in your Corporate Finance 1, you learned that generally, right, for a project, you can either evaluate it with NPV, or you could evaluate the project based on the internal rate of return. And generally, if you're using NPV, if the NPV is larger than 0, then you would know that at least this is a profitable project. And in the IRR case, this implies the IRR should be larger than your cost of capital, right? Okay, now let's see in this case, how can we use IRR here? So basically what we will do here is we will look at what is the IRR. And we find out it is 7%. Why it is 7%? Because if we discount these cash flows with 7% discount rate, then we will get a NPV of 0. And by the definition of IRR, we know that 7% is the internal rate of return, right? So it's pretty easy to see this. Okay, now the confusing part is, how do you use IRR to evaluate the project? Remember that in Corporate Finance 1, if IRR is larger than the cost of capital, then you would know that this is a positive NPV project, right? So basically, if IRR is larger than the cost of capital, then this is a desirable project. But in this case, what you can see here is the IRR here is 7%, and the cost of capital, which is the after-tax borrowing rate, it is 5.2%. So what you can see here is the IRR is larger than 5.2%. Can you say leasing is desirable because its IRR is larger than the after-tax rate, right? Can you say this? Well, you cannot. So here, the IRR is larger than the discount rate of 5.2%. In this case, this basically tells you that leasing is undesirable. So this is really related to the IRR rule from Corporate Finance 1. So what we have learned is something like this. So if the initial cash flow is negative and future cash flows are positive, in this case, if IRR larger than the cost of capital, then you will know that its NPV is larger than 0. But here, in this case, we're having the opposite signs because the initial date cash flow is positive and future cash flows are largely negative. In this case, if IRR is larger than the cost of capital, then NPV is actually smaller than 0. So you have to be careful with how to use IRR rules, right? It really depends on the sign of cash flows. Most importantly, the initial date of your cash flow. If your initial date cash flow is a cash outflow, then if IRR larger than the cost of capital, then this is a desirable project because this NPV is larger than 0. But if the initial date cash flow is a cash outflow and future cash flows are let me restart. But if the initial date cash flow is a inflow and future cash flows are outflows, In this case, if IRR is larger than the cost of capital, then your NPV is actually negative. So in this case, we are talking about the second case here, right? That is, the initial cash flow is positive. So in this case, the IRR of 7% is larger than the cost of capital of 5.2%. And we know that this is a negative NPV project, which means leasing relative to buying is undesirable. So we basically talk about, roughly speaking, three methods here, right? So the first method is we look at the incremental cash flows, and we will only discount these cash outflows. That is, we will only discount these cash flows, and we will find out, well, this cash flow will give me a number of 39,622. In this case, it is larger than $38,000, so leasing is undesirable. And then the second way is quite simple. That is, you will basically just calculate the NPV of all these cash flows. And if you find out it's a negative NPV project, then you would say that leasing is undesirable compared with buying. And then the third is to use IRR. You will look for a discount factor which makes sure the NPV of these cash flows equals 0. And that is your IRR. In this case, because the initial date cash flow is positive, then you would know that if IRR is larger than your cost of capital, then you will have a negative NPV project. So leasing is undesirable. Among all three methods, right? If you have the freedom to choose which method to use, I would say just use NPV, right? Just calculate the net present value. It's much more intuitive. Okay. Good. Oh, yes. Evaluating a true tax lease. So let's summarize. How do we evaluate a true tax lease? So here, the word evaluating basically means you want to think about your choice, right? Lease versus buying. First, you will compute the incremental cash flows for leasing versus buying. And you will always finish this step. It's necessary. And then you could use the simplest method. You will compute the NPV of these incremental cash flows, right? Importantly, the discount factor you should use is the after-tax debt cost of capital, or the after-tax borrowing rate. And then you will look at the NPV number. If NPV is negative, this basically tells you that leasing is undesirable compared with buying with debt. Of course, if NPV is positive, then this means leasing is preferred to buying with debt. Okay. Now let's look at this example here. So let's suppose SPAFX rejects the lease we analyzed, and the lessor agrees to lower the lease rate to 11400 per year. Does this change make the lease attractive? So basically, the annual lease rate decreases. So let's see how we could pursue this question. So remember the first step. You will always want to find out the incremental cash flow of leasing versus buying, right? So to do this, you will want to examine how cash flows will change. First, you can see that the free cash flows from buying should stay the same, right? And the free cash flows from leasing will change. Because previously, the lease payment was $12,000 per year. Now, the lessor reduced the lease payment from $12,000 to, I forget. I think it's 11400, right? In this case, you can see that lease payments will change, and income tax saving will change, right? Because income tax saving essentially comes from the tax shield. So if lease payment changes, then income tax saving changes. Okay, now let's see how can we do the calculation. So I will directly use the answer key because it's pretty straightforward. As I said, this part stays the same. And then the lease payment will change. If lease payment changes, income tax saving changes. So the free cash flow from lease changes. And we will basically recompute the free cash flow from leasing. And then we will recompute the free cash flow from lease versus pay, right? This is pretty easy because you will basically use the cash flow from leasing minus the cash flow from buying, right? Cash flow from leasing minus the cash flow from buying. And then we would discount these cash flows. Use 5.2% discount rate, right? So you can see that this will actually give you a positive NPV. So this tells you that the lease is attractive. It's preferred to purchasing computers with debt. Okay. So until now, we assume the lease is a true tax lease. And now let's discuss how could we evaluate a non-tax lease. Well, remember, if it's a long tax lease, then the lessee will actually receive CCA deductions. So there will be depreciation in the income statement. And the interest portion of the lease payment is deductible. So this will count as essentially interest expense in income statement. And you can see here that a long tax lease is really similar to debt, right? Since a long tax lease is similar to a debt, then what you will do is you will discount the lease payments at the firm's pre-tax borrowing rate. And then you will compare it to the purchase price of the asset minus its residual value. Or you could use the internal rate of return from lessee, and you will compare this IRR with the borrowing rate. Okay, let's see how this exactly works, at least conceptually. Now, if you think about this, we learned in the beginning of the chapter, supposedly, present value of lease payment in a perfect capital market, right? Present value of the lease payment equals the purchase price minus the present value of the residual value. Right? Now, if you think about when a non-tax lease is desirable, you want to compare this left-hand side with the right-hand side, right? That is, you will compare the discounted lease payments with the difference between the purchase price and the residual value. Clearly, if the present value of the lease payment is smaller compared with the difference between the purchase price and the residual value, then you will say leasing is desirable, right? Obviously, if the left hand side is larger than the right hand side, then you would say that leasing is undesirable. Okay, so let's see how. We still have to talk about this IRR rule. So, to solve this IRR, you will basically look for the discount rate which makes this equation equal to 0, right? And then you compare this IRR with the borrowing rate. Okay, let's see this example. It will give you a clear idea how this works. So suppose the lease in the last example is a non-tax lease. Will it be attractive for SpotFax in this case? So now let's pursue this question with two methods. So we will first compare the discounted value of the lease payment with the difference between the purchase price and the residual value. And then the second method, we will calculate the internal rate of return and we will compare the IRR with the borrowing rate. Remember, the pre-tax borrowing rate is always 8%. And the lease payment is, it's $11,400 per year. And this is a 5-year lease, right? And I think the computers has a life of 5 years. So in this case, you can see that residual value is 0. And the purchase price of these computers is $50,000. So what I will do is I will compare the present value of these payment and the purchase price minus the present value of the residual value, which is just $50,000. Now, how do you compute the present value of your lease payments? Well, we discussed this in the beginning of this chapter, right? You will use this modified and annuity formula. So if you have the timeline here, if you look at the timeline, it's a 5-year lease. And so we will have 5 lease payments, right? So it's 11400, 11400, 11400, 11400, 11400. Right? So what you can see here is this is a annuity, right? So, and what you can see here is the present value of lease payment is the first lease payment plus 11400 divided by the 8% and 1 minus I almost forget the annuity formula. Hope I am correct here. Right? So that's it, and you will find out the present value of the lease payments equals 49158. And then you will compare this present value. You compare this number with this number. And you find out the present value of the lease payment is smaller than the purchase price. And you can see that this basically means lease is preferred, right? Okay, now let's discuss the second method. We will use the internal rate of return. So what you will do here is, as I said, to calculate the internal rate of return, you will make sure the purchase price minus the residual value minus the present value of the lease payment equals 0. In this case, you will solve the discount factor, which makes this equality whole, right? And this discount factor you can solve will be your internal rate of return. So you can see that the IRR here is 7%. And you can see that the IRR is smaller than the cost of capital. So this basically tells you that leasing is desirable, right? Okay, this section is pretty much optional, so you could safely skip this. It will not appear in your homework or in your exam. Okay, now let's review this chapter. Oh, we only have 2 review questions. So in a perfect capital market, how is the amount of a lease payment determined? Well, this is pretty simple, right? So we know that if it's a perfect capital market, then present value of the lease payment equals purchase price minus the present value of the residual value. What discount rate should be used for incremental lease cash flows to compare a two-tax lease to borrowing? The discount rate you would use would be the after-tax debt cost of capital or after-tax borrowing rate. You want to use the after-tax borrowing rate because when you're dealing with these incremental cash flows, these cash flows are after-tax cash flows. So when discounting these cash flows, you will want to use after-tax rate. Okay, now let's proceed to the next chapter, which is chapter 26. So here we will talk about some short-term financial management. So here we will start with working capital management. So what's the motivation, right? Well, because if you manage working capital efficiently, then you will generally tie less cash flow in your current asset and in your current liability. So this basically means this will increase your free cash flow. So this has the potential to increase your firm's value. Okay. First, what are the main components of net working capital? Well, we know that net working capital equals current asset minus current liability. And we know that the main components of current asset is cash and inventory and accounts receivable. And then the main component for current liability would be accounts payable, right? And you guys have learned about these concepts in your corporate finance 1 class. Okay, so how do we measure the efficiency of working capital management? So here we will talk about two concepts: the operating cycle and the cash cycle. So what is the operating cycle? It is the length of time between when the firm buys its inventory and when the firm receives its cash from selling its product. And the second cycle is the cash cycle or cash conversion cycle. It is the length of the time between when the firm pays cash to buy inventory and when the firm receives the cash from its product. So these definitions are quite dry here. But if you look at this picture here, then it will be quite easy to understand these 2 cycles. So let's look at these. Let's look at this picture carefully. So first you can see that we have the timeline here, which is really, which is really how a business will typically work, right? So the first the firm will buy some inventory, and the firm will pay for inventory. And then after turning the inventory into product, the firm will sell its product. And after selling the product, the firm will wait for a period to receive its payment from its customers. So this basically means the length between when the firm buys inventory and when the firm sells product would be inventory days, right? Because inventory days tell us how many days or after how many days the firm can turn its inventory into product. And then the time between when the firm sells product and when the firm receives payment would be the accounts receivable days, right? That is how many days the firm has to wait to receive its to receive cash, receive money from its customer. And then the difference between when the firm buys inventory and when the firm pays for inventory will give us accounts receivable days, right? That is how many days the firm can wait until it pays its supplier. And based on these days, we can define operating cycle, right? You can see that operating cycle concerns one full cycle of operation, right? So it equals inventory days plus accounts receivable days. And then what you can see that the cash cycle measures the length of time between cash out and cash in. Mathematically, cash cycle equals operating cycle minus accounts payable days, right? So we will have the following formula. As I said, operating cycle equals accounts receivable days plus inventory days. And then because cash cycle equals operating cycle minus accounts receivable days, so we can see that cash cycle equals accounts receivable days plus inventory days minus accounts payable days. And we basically have three kinds of working capital days in these two formulas, right? And the formula to calculate these working capital days are given here. So accounts receivable days is calculated as is calculated as accounts receivable divided by average daily sales. Inventory days is calculated as inventory divided by average daily COGS. And accounts payable days is calculated as accounts payable divided by average daily COGS. Here this table gives us the operating cycle. So this is operating cycle and cash conversion cycle for Canadian firms. First, what you can see here is the operating cycles between different firms are quite different, right? If you look at some firms, they have very large operating cycle. For example, if you look at this firm, right, this pharmaceutical firm, its operating cycle is almost 250 days. And some firm has really short operating cycles. For example, if you look in WestJet, right, it's almost 20 days. And you can imagine that we will see large differences in cash cycles between different firms. And what you can see here is, interestingly, a lot of firms, they have negative cash cycles, right? How do you have negative cash cycles? Well, if you look at the formula here, if your accounts receivable days, if your accounts payable days is larger than your operating cycle, then you will have negative cash conversion cycle. Right? So this is interesting. This basically means that you will, as a firm, you will first get payments from your customers before paying your suppliers, right? And you can see that a lot of firms, they're doing this, right? A lot of firms, they have this negative cash conversion cycles. I would say for these listed firms, at least 50%. Okay, so why do we care about working capital management? Well, I mentioned this in the beginning of this chapter because if you reduce the working capital requirement, then you will have some additional positive free cash flows. So this will essentially increase your firm's value. Okay, now let's look at this example here. River City Paints would like to construct a new facility which will manufacture paint. Oh God, this is a long. Let me see the numbers, right? So the management estimates the project will require an investment today of $450,000 for net working capital. And the firm will recoup this investment in 8 years when the firm closes the plant. So the discount rate for this type of cash flow is 6% per year. What is the present value of the cost of working capital for this paint facility? Well, this is pretty simple, right? It basically means that in the beginning of the first year, there would be a cash outflow of 45000. And at the end of the 8th year, there will be a cash inflow of the same amount because the problem says the firm will recover the investment in 8 years. So basically you can see that the present value would be the cash outflow plus the discounted value of the cash inflow. And this will happen in 8 years. Right? So this will give us something which is definitely smaller than 0. So it's minus 167. So this is 167, 664. Right? So this is the cost if you invest in this net working capital. Okay, now we talk about trade credit. So trade credit is related to a firm's accounts receivable. So why a firm has accounts receivable? Well, because a firm, they will extend credit to its customers. That is, a firm will allow a customer to pay for the goods at some later date. And this later date will be later than the date of purchase or the date of invoice. So this will create the accounts receivable. So essentially, accounts receivable tells us how much credit the firm is extending to its customers. So this credit is called as trade credit. And now we will want to think how managers would determine the optimal trade credit policy. Okay, so first we will learn some trade credit terms. So let's look at this. net 30 or N30. What does this mean? Well, it means that the payment is not due until 30 days from the date of the purchase, right? So similarly, if you have net 15, it basically means the firm's customers can wait for 15 days to pay the invoice, or net 60. And let's look at this guy here. So 210 net 30. Well, this says if the firm's customer pays within 10 days, this number, then they will receive a 2% discount. Otherwise, after 10 days, they will have to pay the full amount, and the full amount will be due in 30 days. So similarly, 110 net 20, it means that if the firm's customers pay within 10 days, then there will be a 1% discount. And if the customer waits for 20 days, then there's no discount, right? Now, what does this mean, right? How do you optimally set these numbers, right? Well, the interesting thing is first, if you think about trade credit, if the firm gives trade credit to its customers, then essentially the firm is making a loan to its customers, right? Since it is a debt, it is a loan, then there will be an interest rate. And the interest rate of this loan is implied by the price discount. That is, the interest rate is implied by this number. Now, let's see how can we compute this interest rate. Let's say we assume a firm sells a product for $100, and the credit term here is 210 and 30. So basically it means that if the firm's customers pays within 10 days, then the customer will get a 2% discount, right? And this means if the customer takes advantage of this discount, she pays $98. Or if the customer does not pay the loan within 10 days, then the customer will have to pay $100. But the benefit is the customer can use this $98 for additional 20 days. So this is equivalent to say this customer is getting a 20-day loan with a face value of $100 and with a price of $98. Okay, let me explain this using a simple picture here. Okay, let's see this. It's 210 net 30. Okay. So this is 10 days. This is 20 days. So basically the customer has two choices. The customer can pay here at the end of the 10th day for, the customer will only pay $98. Or at the end of the 30th day, the customer will pay $100. So if the customer chooses this, right? This is equivalent to say that the customer keeps $98 at the end of the 10th day and continue to use this $98 for 20 days. And then the customer will have to repay this $98. And the face value of this $98 is $100, right? So now you can calculate the interest rate of this loan, right? That is, you get $28 and you use this $28 for 20 days, and then you will pay back $100 How do you calculate the interest rate? Well, it's easy, right? So the 20-day interest rate is given by, oops. So the 20-day interest is given by 100 divided by 98 minus 1, right? But this is just the interest rate for 20 days, and we want to annualize this. So the effective annual rate would be this number, and 365 divided by 20 minus 1, which is 44.6%, right? Okay, so you can see that if the customer decides to take the discount, it will save this interest rate, right? And you can see that this is a pretty high interest rate. It's 44.6%. So generally, if the customer can obtain a bank loan at a lower interest rate, remember that the annual rate for this is 44.6%. And I'm pretty sure that most likely you will be able to obtain a bank loan at a lower interest rate. In this case, the optimal action of this customer is the customer should borrow this $98 from the bank, right? And the customer will pay this $90 to the supplier to take advantage of this discount. And then the customer will repay the bank on day 30. Right? Okay, now let's see this example here. So this example is about estimating the interest rate of the trade credit. So let's say your firm purchased goods from its suppliers on terms of 115 at 40. What is the effective annual cost to your firm if it chooses not to take advantage of the trade discount? So it means, so this trade credit term means if the customer chooses to pay at the end of the fifth day or on day 15, it will get a discount of 1%. So let's assume the total amount is 100. Then a 1% discount means the customer will only need to pay $99. And if the customer decides to not pay on day 15, it will pay on day 40. Then the payment would be 100. So you can see that this is a length of 25 days. This tells us the annualized effective annual rate would be 100 divided by 99, 365 divided by 25 minus 1, which is 15.8%. Again, as the customer, you will compare this rate with the rate you can obtain from other sources, right? If this is the lowest rate you can get, then you will wait and pay your supplier on day 40. But if you can get a 10% loan from a bank, then you will first borrow money from the bank and use the bank's money to pay your supplier on day 15 to take advantage of this discount. And then on day 40, you will repay your bank's loan. Okay, now why firms offer trade credit? Because essentially firms are not banks, right? But still they will want to extend credit to its customers. Well, there are several economic reasons. The first is maybe the supplier has private information about the customers. So for example, if the supplier understands that the customer has very good credit, in this case, the supplier will be willing to offer the customer a more generous credit policy. And if the supplier knows the customer has bad credit, then most likely in this case the supplier will want to use very strict credit policy, or not, or maybe the supplier will not give trade credit to this customer with bad credit history. And the second reason is the credit risk faced by the supplier is possibly very small. The reason is generally the supplier and the customer, they have an ongoing relationship. So they have the incentive to maintain their ongoing relationship. This means the customer will have very small incentive to default. And another reason is the supplier can seize the inventory of the customer if the customer defaults on the trade credit. So trade credit is essentially like a secured loan with collateral. Thus, it has small credit risk. Okay, next we talk about receivable management. So basically, we will think about how the firm can think about a optimal policy for trade credit. That is, how it can monitor its accounts receivable. So the general approach to think about a firm's credit policy is, first, the firm will want to think about its credit standards. That is, which customer will qualify for its trade credit. Of course, you can see that if the firm has enough information on its customers, then generally the firm should give credit to customers with good credit history. Okay, the second step is to think about credit terms, right? We have seen this. That is, let's say if you have 1-15-40, then you can see that there are several things to think about here. As a firm, you want to think about the longest period you want to extend the credit to your customer. And then you want to think about how large the discount you want to use. And then you also want to think about this discount window. The third step is to think about a collection policy if there is a delay in payment or there is a default. So there are obviously multiple policies. You could send a letter to your customer. You could charge interest payment on your customer. Or you could use legal actions. Okay, now how a firm could monitor the accounts receivable? Well, the firm will look at the accounts receivable days and the aging schedule. First, what the firm can do is it will think about its credit terms and compare the credit terms with its accounts receivable days. For example, if the firm has a credit term which is net 30, then it basically means that all customers should pay the firm within 30 days. And then you will look at each customer's accounts receivable days and your average accounts receivable days. For example, if you find out your average accounts receivable days are actually 45 days, then you can see that, well, on average, your customers are actually 15 days late, right? And a firm could also look at the trend in accounts receivable days, right? You will ask, has my accounts receivable days increased or decreased? And why the accounts receivable days increased or decreased? For example, in the pandemic, maybe you will expect an increase in your accounts receivable days, right? Because most small businesses are having a bad time during the pandemic. And you could also prepare the aging schedule. This is so aging schedule will basically categorizes customers' accounts by the number of days they have been on the firm's books. If you look at this example here, it's actually pretty easy to understand. So here you can see that the firm is preparing a aging schedules table, and you can see that we have all these different days outstanding. So let's say if you have a net 30 credit policy, then you can see that these accounts, right, they're within this 30-day time limit. But for these 160 accounts, they're late, right? And you would also want to look at account percentage. So basically you can see that about 28% of your customers, they're late on their payment. And maybe more importantly, you want to look at the amount. And you can see that the percentage here is about let's see, what's 30, I guess it's about 38 or 39%. I guess it's 39%, right? So it's about 39%. You can see that, well, the percentage of accounts which is late is actually relatively small, only at 28%. But their amounts are actually quite large, right? 39% of total amounts is actually late. Okay, now let's see this very simple example. So financial training systems builds its accounts on terms of 310 net 30. The firm's accounts receivable include $100,000 that has been outstanding for 10 or fewer days, and $300,000 which is outstanding for 11 to 30 days, and $100,000 outstanding for 31 to 40 days, and $20,000 outstanding for these days, and $10,000 for these days, and this amount for these days. Prepare an aging schedule for FTS. What you will do is you will basically just follow this table here, right? You will have 5 different columns: days outstanding, number of accounts, percentage of accounts, and account and amount outstanding, and percentage outstanding. So, this is actually a simplified version. So this one only concerns amount outstanding and percentage outstanding. Because the problem does not give us number of accounts, right? So for example, for 1 to 10 days, the amount is 300,000, right? So we have 1 to 10, and we have $100,000. Oops. And then for 11 to 30 days, we have $300,000. So we have 11 to 30 days, we have $300,000. And then for 31 to 40 days, we have $100,000. We have this number here. And then we will basically do the same for other days outstanding. We will have these two columns. So after having these two columns, we can calculate the percentage outstanding, right? Because basically you can see that for this number, it's just $100,000 divided by the total amount outstanding, which is 532,000, right? So this gives us a number of 18.8%. So if you look at the firm's credit policy, it uses the credit term of 310 net 30. So if you look at the days outstanding, you can see that the percent outstanding, which is within the 30-day limit, is about, I think it's 75%. So 25% of the total amount is actually late, right? So maybe you should look into these customers and call them, ask them why they're late, when you can receive your payment, right? Okay.